All right, there we are. It's a live stream Tuesday from a very dark and stormy North Carolina. Hurricane tropical storm, I can't remember the name, is headed up here. So maybe, hopefully, everything will, internet and light will all stay up. I did a sort of like an impromptu live stream yesterday. So we'll keep this one kind of short. Throw your questions in. I'm going to talk a little bit about Bitcoin, a little bit about the market, a little bit about our stocks, and then and close it off. But before I do that, got to do the legal stuff, which is that this live stream, the content from ATG Digital Media, is not investment or financial advice. It is presented to you as opinion, information, engagement, and entertainment. All ATG content may contain errors, oversights, and mistakes, and understand that investment operations, which means what? Buying or selling a stock, crypto options, have significant risks and can lead to the loss of your principal. I, the owners, employees, contractors, own, trade, transact, and securities that mentioned in this video and all of the content from ATG Digital Media. We do not take money from companies or from crypto promoters to recommend their stocks or crypto tokens. Very rapidly, this is a lot of the free media that we publish. There is the Substack, there is my podcast on Spotify, and what I'm on YouTube. And here are my socials: X, Instagram, Facebook. Pretty active across the board. All right. So we went through a panic. I think to call it a crash would be like a little excessive, being that I even looked. I mean, like, the markets are still within like 10-15% of all-time highs. Right? I mean, it's just that if you were in very particular stocks, the very hot stocks like Nvidia, or if you're in things like Intel, yeah, there you've definitely, like, from the top, you've faced a crash. But I did this analysis for the team, and Nvidia is still up like 100 and something percent, for the year. So, I mean, we really haven't seen a whole lot. So the idea as well, there are people calling for an emergency Fed cut, calling for some sort of like, as if like some enormous crisis has happened. Yeah, I'm thinking that the Federal Reserve is probably not on the same page as those people, which is that I do not think that whatever we've seen in the stock market or the crypto market or any other market, truthfully, even in the real estate market, is going to make the Federal Reserve go to a emergency like 0.5% cut, 1% cut. I mean, there's crazy things that are being put out there. Now, I mean, if they did this, that would be kind of insane, because we have what in the economy? I mean, last quarter anyway, GDP grew by 2.8%. The current rate of unemployment, it just hit 4%, which it's not a crazy high number where it would call for emergency action. It's clearly trending in the wrong direction, but it's not something that would call for immediate action. As far as we can see, the markets are liquid. There is no genuine emergency. In other words, if you want to sell something, you may not like the price, but you can sell. So none of the things that usually cause the Federal Reserve to say, like, okay, we got to act here, none of that, is in play today. Instead, what we've had is a surprise. I mean, that's really what happened. In other words, we've seen that some of the assumptions underlying prices, certainly for many stocks, not our stocks, not the innovation and growth sector, really for the stocks that have risen the most over the last 3 years, which are mega cap stocks, and in particular mega cap tech stocks. Yeah, those assumptions, are based on the idea that the growth will continue. I mean, these companies are so big, they need the economy to probably grow at between 2 and 3%. Despite whatever anybody might say, I mean, the truth is the very large tech companies are not that innovative. I mean, they don't do anything new, so they're not going to take market share from somebody else. I mean, they need either more money to be issued, or the economy to grow in some way, more consumers to somehow be produced. That's very different than a genuine innovation company where there's something unique, different about your product, your service, your technology platform, and you're taking market share from somebody else. So you don't depend as much on overall economic activity. So for the folks that need the economy to be at 2 to 3%, yeah, seeing unemployment go to 4.3%, yeah, not such a good thing. Seeing that unemployment claims are going to come in higher for the second half of the year, not such a good thing because it means less spending. And if your stock is trading at 30 times earnings, 35 times earnings, crazy valuations relative to history, yeah, I mean, professional investors are going to sell your stock down. They are going to take their gains and they are going to move on, and they are going to look and seek out other opportunity. At the same time, I will say that tracking lots of macro indicators, I doubt we will have a severe recession if we have one. I think it'll be similar to 2022, where we had some quarters where we had negative growth, but we never had like a negative 4% GDP number. We never had a negative 7% GDP number. And there are some reasons why that is the case. I'm going to actually just try and get this person up. And let's see. Because I want to point to something that is actually going on that most people really are just not that focused on, which is that, okay, here is the page. So there's this extraordinary factory construction boom happening in the United States. I mean, this is a new thing. This is an unusual thing. And this is, for our companies, this is an opportunity. For bigger companies, this is a cost. So what's going on here? I mean, look at these numbers. I mean, these are what, multi-decade numbers of construction spending on manufacturing plants. Now, some of it is chips. A lot of it is actually EV related. Battery facilities that are being put up is a big one. But from there, it's all kinds of things. I mean, and the general thing that you can kind of guess from looking at that chart is that it begins with the whole supply chain crisis starting 2020 and 2021, where we begin to reopen our economy. China continues to keep its economy closed, and we start to have extraordinary crises around getting very simple things, because it turns out that we have shipped pretty much the production and making of everything to China, that everything is sort of like caught up in this extraordinarily intricate supply chain, and we can't get small parts. Like, even if you have this part, you need this part from here. And that begins a rethink at every level, at the government level, at the corporate level, even at the small business level, which is that we cannot have and cannot be this dependent on another country, specifically one country where, we have obviously geopolitical tensions, we have, all these things where we're so dependent on them, where, they can potentially like really disrupt our lives in significant ways. So companies begin investing in a very big way to bring their supply chains to both diversify them so that it's not so China dependent. And that means, spreading it out a little bit more in Asia, or bringing, in some cases, to Mexico or even Canada. but also really to bring it back to the United States. And you can see, I mean, this is a big number. Now, for let's say a large company like Apple, this is a cost, right? I mean, they have all of their iPhone manufacturing in China, all, right? They don't really produce iPhones in the United States, right? I mean, so for them to either diversify and say, okay, well, we want to move some out of China, I understand, they now produce them in some other countries, but let's say something were to occur in China and there was some disruption in trade. I mean, Apple would not be able to produce iPhones. And this is now not just a sort of like a thought. I mean, this is being considered. So they're obviously diversifying, but their original plan was to produce in China. So this is an extra cost for them. For us, and the stocks and investments that we're in, this is an opportunity. Our companies make the things that would go into many of these manufacturing plants. One of the obvious places is obviously 3D printers. If you're putting up a manufacturing plant in the United States in 2024, you are going to do it with a digital platform. You are not going to do it in the way that you might have in 2010 or 2014. Because the world has changed a great deal. It's far more digital, it's far more virtual. And so even as the economy is slowing, you have this factory boom going on, right? And it's not a story that you're reading very much about. If you're on CNBC, if you're on Yahoo Finance, they of course are going to follow the very big things. But this is where you want to be invested. This is where the money that is selling out of the big cap, mega cap tech stocks, and the S&P 500, which is dominated by the top 50 stocks, they're going to search out opportunity. They're going to search out growth, and they are going to find it. And these are going to be in much smaller companies compared to these multi-trillion-dollar behemoths that dominate the S&P 500, the Nasdaq 100. So the scenario as it's happening, because we have seen over the last month in particular, you've seen, for example, the Russell 2000 index has made a new high. In fact, right before we had this, whatever you want to call it, mini crash, or whatever you want to call it, the Russell 2000 index made a new high. The Russell 2000 is a small cap index, and that caught my attention. And making a new high is a statement. In other words, somebody with a fairly large amount of money, because to move an index, you kind of need a lot of money, right? I mean, and they were willing to pay a new high level. And that would not be something that a professional investor would do, unless they felt that, hey, there's something here. I have to put myself out there, because a large investor, when they enter a market that has been sort of like in a bear market, like small cap and mid cap stocks, innovation and growth stocks have been in a bear market for about 3 years now, as all the money flooded into very large stocks. When you enter a market like that, well, you're going to move it. And if you're buying, you're going to move it higher. And once your buying interest is there, I mean, of course, it'll track back down, because for prices to be sustained, you have to have, buyers keep coming in. So of course, the early investor, they're going to move it up, but they have so much money, they have no choice, and they accept that. And this is definitely one of the things that really marks 2024 economy, let's say from the 2008 economy. Like, people making comparisons to 2008 and the global financial crisis, they don't know what they're talking about. We have today an entire sector of our economy, let's call it the digital sector, right? Which is different than the industrial sector, different than the service sector, different than the commodity and agricultural sector, that runs counter-cyclical to everything else. So you can have housing activities start to go down, and it doesn't matter, because you're not going to reverse 20 years of sending all the factories and manufacturing plants to China in the space of 4 years. It is going to take, I mean, it'll take at least 10, 15 years. So this chart is going to keep going and keep going. And there are companies that benefit from this. And these are the companies that are going to keep growing, and the money will find them. I can tell you, investors are always seeking out opportunity, always seeking out growth. They will find them. So what I have laid out is a transition scenario. In other words, you've had this enormous, 3-year bull market for very large stocks. And those stocks are very overvalued, in my opinion, obviously, trading at 25, 30 times sales and earnings. And then you've got the rest of the market, which has really been smashed, destroyed. These are cheap. They're underowned. They're undervalued, in my opinion. They have earnings growth. They have sales growth. And so they tick all of the things that we need to see, which is that they've got something that is of value. In other words, that growth, that's valuable. They're scarce because people have spent 3 years selling them and buying something else, and people are loaded up on what? Well, they're loaded up on what's gone up. I mean, and that's, the mega cap stocks, right? And what we now need is obviously for that money to push in, and that's the demand that pushes prices higher. So, well, I mean, days like Monday, Friday, not, very happy days in terms of any stocks, including ours. Like people may be like, well, Paul, if you're right, well, why are our stocks still going down? Because you know what? Fear is pervasive. Yeah, I mean, the number one thing that people do when they feel fear is they don't ask questions. They don't use facts or logic. Instead, it's sell first, safety, cash, then maybe if I feel okay, I'll go in. So logic is not the thing that is used during a panic or during any point where sellers are rushing en masse for the exit, right? But as 2024 lays out, this is what I believe you're going to see, which is that the economy will get weaker into the second half of 2024. We know this because while the digital sector is something like between 10 and 15% of the economy, you've got then the service sector, the industrial sector, and the agricultural sector. The agricultural sector is very, very small. The industrial sector is, probably, I'd say maybe 10, 20%, but the services economy is where it's the biggest. Those are all sort of like weakening at different levels, but the digital economy is continuing to grow. So in the second half of this year, because we've got all these different parts moving at slightly different speeds and slightly different directions, it's kind of like going to be tough really for the US economy to show like terrible growth, right? I mean, which means that there's no real prospect, for example, for the Federal Reserve to cut interest rates in emergency fashion back to 1% or 0.5% like they did during the global financial crisis. I think that's a zero possibility. But what we can see is like probably somewhere, I would say, earliest would be fourth quarter of this year, which would mean like, starting October, November, December, or very early next year, we'll start to see some interest rate cuts come through. And now we have two things that are really working in favor for us. And if you're a growth and innovation investor, which is that our companies are growing because they've got something unique that is going on that is separate from just overall economic growth. That is this factory boom, this reshoring trend, or the fact that innovation by itself, like, you have something that's different, right? I mean, and so you represent an alternative. And because innovation companies are built on digital platforms, they can often provide whatever product or service and hold the price or else even cut price to take market share. Incumbent legacy companies cannot do that. Their costs are not going down. So uh, they're losing market share. So innovation kind of has this unique element. So they're going to have sales growth, and because of the 3-year bear market, these companies have really, they've cut costs. They no longer have projects that just, might lose money, but add to growth. So, growth at any price is gone. Unlike the big tech and the big companies, they didn't overhire. Instead, they've been cutting staff. So they're very efficient, and they're going to produce not just sales growth in this cycle, they're going to produce earnings growth. When the Fed cuts, now there's going to be a reversal of thought process from what we have seen over the last 3 years. Now, if you remember, going back to 2021 and 2022, the macro argument that was used by the people to say, like, well, these profitless tech companies, these innovation companies, you see, under rising inflation, the future cash flows, which are very critical for innovation companies. Why? Because, well, a young company, their peak sales, their peak earnings, their peak profits are far out into the future. So if, all companies are valued based on their future cash flows. So if the value of money is declining, as it would be under rising inflation, then obviously the values of those peak cash flows, they're getting lesser and lesser. But with economic growth set to slow, inflation set to go, most likely it's going to get to 2%, maybe even dip below 2% for a few quarters. With that interest rates going down, well, the future cash flows are now worth more. So the macro argument also is there for investors to come in and start to bid up innovation and growth companies. So in other words, we got all the ticks setting up. In other words, we got growth, and we have value. We have scarcity because everybody has spent 3 years dumping all these stocks, which is why they all, despite the 3-year bull market in the S&P 500 and the NASDAQ 100 and all these indices, our stocks are not at all-time highs. Our stocks are still 50, 60, 70% below their highs. So that tells you where the demand equation is. People have not been buying these because when people are buying, prices rise. The demand pushes prices higher. So, and then we've got the setup for demand to come, which is what? Lower inflation, lower interest rates, and also a demand and supply equation, scarcity that favors us. And we don't have to guess at this because we can kind of see. There are inklings of this from earlier this year where people have seen the scenario and setting up for it. And, these transitions are never perfectly smooth. It's not going to be like, oh, everything will just be, nice and easy. No, as people sell out of the old trade, the old trend, which is the mega cap, mega tech stock trend, that will cause volatility. There'll be up and downs. But what you will see is that increasingly as we go through this, a lot of our stocks will start to hold more and more of their price gains, even during sell-offs. And then we're going to arrive at a point where, they start to approach their old highs, and then they will start to take them out. And given how painful and how difficult this bear market has been, it tells me that our stocks are incredibly underowned. And so as the sales come through, that's a surprise. No one is expecting these companies to be profitable because, they've lost track of them. If you're not owning something, you don't track something. So nobody really knows the work that these companies have done. So that's a shock. And then as the prices rise, people are like, well, the prices are set by professional portfolio managers who are in an annual competition, right? They gotta perform every single year or else get fired by their clients. So they have an incentive to go seek out opportunity, to go seek out growth. And if they can't perform, then they get fired. I know this from having been in this industry myself. It's a brutal, it's merciless. Clients don't care about anything. They will just pull money from you if you cannot compete with whoever is generating better results than you. So there's a huge incentive that's there to seek this out. And that will drive money to where there's opportunity and where there's growth. And after 3 years of like these mega cap stocks being where they are, yeah, money is clearly, you are seeing this by the fact of Intel dropping 30%. People like, yeah, I can't be there because who was hiding in Intel? Well, these are the folks that are thinking like, well, Intel's cheap relative to Nvidia. I'm going to do this relative value trade. I'll make a lot of money. I'll be a big hero. I'll make my clients a lot of money. I'll generate big bonuses for myself. And folks, they're like, yeah, we're giving up on that. That's not going to work out. And with that, of course, the whole AI trade sort of began to come undone. So there's somebody that's there that is sussing out this trade, and they're going to start to push money. Once they start to have performance, other people are like, what are they doing? And people will copy them. The most fundamental thing in human life, and certainly in markets, is people copying each other. And once one person has success, other people are like, hey, whatever they're doing, we have to get a piece of that. And I believe we are going to see an extraordinary, maybe it'll be close to the second half of this year, but 2025 will be very, very, very good because everything, the wind is like at our back, like the micro stuff, sales, earnings, wind is at our back. The macro stuff, inflation, interest rates are back. So this is the ideal, perfect environment for innovation and growth to outperform. And given the size of the bear market, I don't mean the length, the size, meaning like 80% drops. Yeah, when stocks come back from that, it tends to be a very long bull market that follows. So we're going to go from terrible to great, and most people won't be able to participate. Many of the very large institutions, they need our companies to be much bigger before they can put any money in. We're talking about, right? The biggest companies in the S&P 500 are all worth trillions of dollars. And the vast majority of our companies, even a somewhat big-ish company, let's say like PayPal, right? Which, has Venmo and PayPal. That's a 60 or 70 billion dollar company. The scale of this is just on another level. So we can experience like, maybe one, maybe two, maybe three cycles before they finally get to a size where the big money can come in and buy. But that means they're going to struggle and we're going to do great. That's a scenario that, in my opinion, is setting up to happen. So I wouldn't be too down about, these. We're going to see some of these days, so when people dump out of these big cap stocks, the nature of Wall Street is this, which is like, if you want liquidity all at once, you have to take a significantly lower price than whatever it was the day before, the week before. So you'll see some of these days, but equally, you're going to see that as the quarters run through into 2024 and 2025, that there's money pushing in, prices hold up better, and we slowly start to approach back into the old highs. Let's see what comments are here. Let me address those, and then we'll finish up. All right. Hey, Paul, what's your current thought on Fannie Mae? It's all linked to politics. Chance of Republicans taking the House and Senate. Trump versus who will win? Can you share your thoughts? I have no idea who's going to win. The polls are truthfully all over the place. It's hard to know. I personally don't think that this is a political trade. I think this is a sort of like a financial system trade, which is that these companies have been operating in conservatorship for 16 years come next month. And there is a point at which I believe that whether it be recruiting personnel, expansion of their current business, that they cannot operate under conservatorship anymore. Under President Trump, there was a clear plan to free them. President Biden froze that. Nonetheless, the plan exists. Almost certainly with the real estate markets headed for trouble, and we can see that in any number of markets. We'll need Fannie Mae and Freddie Mac to be operating. There's also what I believe would be a politically popular program with second mortgages, which people, can go and take the substantial equity that is sitting in many folks' houses. I don't think they can really scale up that program under conservatorship. So many people see it as a political trade, but then many people also saw it as like something that was going to go through the courts as little as like a year or two ago. And truthfully, that has never really panned out. Like no judge has been willing to go against what the government wanted to do. So I think if the politicians were going to get involved and actually pass some legislation, they would have done it a long time ago. So this, I think, is just going to eventually be like, okay, time's run out. Nobody has a better solution. Let these things go. I've always favored the view that these are kind of like financial utilities, and that's kind of like what they will be operated like. Perhaps that's the way they should have always been operated like. And that was more or less the construction that all the movement to free them was going in. And I think irrespective of whoever's elected, this will be what will happen because there's no choice other than this. I don't know what that means. Hey, Raul. Am I looking at Fannie Mae and Freddie Mac to about $1? Well, I mean, you have to understand something about stocks that trade on the over-the-counter exchange, right? I mean, there is no liquidity on these exchanges, right? So when you go through a panic, people don't care, right? I mean, they're going to sell everything first, get cash, and then ask questions later. So, I mean, you benefit from that when demand comes in because that illiquidity means that you get big price jumps, but equally during a panic, you get big rapid drops as well. I never believe in loading up and being like reactive to price unless you have really high conviction. You're completely okay with accepting the risk if the trade goes wrong. I generally believe in holding a diversified portfolio. You make your size of bet, you size it in that way, and then you leave it alone. And with the potential in Fannie Mae and Freddie Mac, I don't think you need to bet the farm. I mean, if these trades are going to be successful, I mean, these companies have like 10x their size in 16 years, and that is not reflected in their stock price. So you don't need to make a heroic bet to make a lot of money. Now, obviously, if you want to become a multimillionaire, and you want to take that risk, you can, but then you also have to equally accept that if it goes wrong, you might lose a substantial amount of your capital. So that's the scenario, that you always face at low prices, which is you want in and you're like, I can see it, but I mean, it has been 16 years. There's no guarantee that I'm right. I mean, I've held the Fannie Mae. I've had a Fannie Mae preferred in one of my IRA accounts since December of 2008. And I've seen ups, downs, ups, downs, ups, downs. And, I would like this to be resolved. And at some point, I mean, at various times during these 16 years, it's happening, it's all over, I won. And then, so, the path to big gains sometimes is like this, sometimes it's like this, sometimes it's like this. And we, of course, always, every trade we visualize is just being like this. Nice, smooth, beautiful line higher. It's never like that. It's never, ever, ever like that. So that's what I'll say on that. This one. Any thoughts on 3D systems? Yeah, I mean, I did a YouTube video on 3D systems 2-3 weeks ago where the stock popped, and then you go and see they had a news release indicating that they had received a contract for $250,000. I believe it was in a dental supplies contract. And in researching this, I was like, okay, this is related to that factory boom. In other words, why is a dental supplies company giving 3D Systems I think it was a 4-year contract for $250 million, even as the economy is slowing? Because there have been signs. Housing is a big factor in the legacy old school economy. And it has to do with this reshoring trend. In other words, they clearly had factories, most likely in China, and they're like, we need a local supplier. And for that, we have to, get that set up right now. So 3D systems and generally speaking, the 3D printing business is doing well. Their stocks obviously are still, in the crater. So generally, I find that when the business is doing well and the stock doesn't, the stock at some point starts to take off. So I'm still positive. I own some 3D systems myself. I haven't done anything more with it. I own a diversified portfolio of a lot of our different stocks, and I'm expecting good things in the second half of 2024 and 2025. I appreciate that comment. Thank you. More comments here. I also want to put up a piece of analysis before I end here. Let me see if I can get this up. I have to get it from our Slack channel. This would be the easiest place. But it's on Bitcoin, which I'll admit is a fairly reasonable part of my personal net worth. So let me just share this. Right? Okay. So you'll see here that Bitcoin's average mining cost is now $83,000 versus a Bitcoin price of 56,000. Now, it's a little bit hard to show this on scale, but one thing you'll see is that the bottom chart, if you will, compares the average mining cost, which is like 83,000 compared to the Bitcoin price. And if you can kind of see, there's like a relationship here as to when Bitcoin prices tend to take off. Now, people say, well, Paul, it just crashed. Yeah, but that liquidation is driven by short-term traders, in all likelihood using massive leverage, right? And so that's actually a good thing. Like most of those folks are gone, and they're most likely shorting it, which is good because like if they're shorting it, and as the price moves up, they'll cover a little bit, and it drives demand. But you'll see that when that on the second level here, which is that when the ratio of the average mining cost to Bitcoin price starts to go higher, in other words, when the cost is significantly greater than the price, what happens is that sort of like the casual miners and the very small time miners, they're like, we can't afford to keep doing this, and they opt out. Now, those are also the folks most likely to sell their Bitcoin and sort of like add supply. And then as like the price goes up, it sort of like goes to the much bigger miners who likely have more cash, who likely don't have to sell Bitcoin. And so now the supply shrinks even more. And I made this point to our team this morning, which is that Bitcoin, despite the crash that you have seen, which is what went from 70 to 48,000 approximately in the space of 10 days, something like that, does not reflect the actual demand and supply position. Bitcoin is very scarce and about to get even scarcer, and it would not surprise me if we just had a shoot up that happened very, very rapidly, that got back to its old high. And even from 48 to 56, you can see there's been almost no resistance. Why? Because all the resistance usually comes from short-term, buying and selling that goes on, usually with leverage. Like there are platforms where you can do 50x and 100x, and that puts selling pressure on. But those folks were definitely wiped out. I mean, a move from 70 to 48, yeah, they're wiped out. In all likelihood, they're not coming back for a while until Bitcoin is at much higher prices. So it would be unexpected. But that chart says we are nearing like something that is about to happen. And that'll obviously take Bitcoin up. It will take MicroStrategy up, Coinbase up. It will take the entire crypto sector up with it. And would obviously be a shock. And then if we're going to get interest rate cuts and obviously, more money pushing into the economy and markets, now that's incredibly bullish for Bitcoin and crypto. So I mean, it's hard for me to, whether it be the reshoring trend or or crypto should be anything other than optimistic about like what is going to happen for us second half of 2024, 2025. So just want to bring that up because I looked at that and I brought it up to the team. I've been tracking this for a while, and this has a pretty good track record of being right. So if that's right, well, what we're seeing is going to keep continuing. And of course, after a crash, what do we all think? Like we get down, and we get like, it's like, whatever's most recently happened is what like our mood is. But the facts, in fact, are going the other way. So if you're down on Bitcoin or crypto, and I made the point all last week in my updates, which is that I think like the number one regret people are going to have, I think in 2 or 3 years time, is that I didn't own crypto because of whatever, and people will become believers at higher prices. So those folks will have regrets. Or I didn't own enough of it. I made it such a small part of our portfolio because I thought it was so speculative and I thought it was so weird. I didn't give it like the appropriate amount. I think this will be like a big regret for people in 2 or 3 years time. All right. I still went on for 41 minutes. That's because I always, want to give good value and provide all the information that we're saying. But bottom line, folks, look, my transition viewpoint didn't mean that it was going to be perfectly smooth, but the selling is confirmation that the transition is unfolding. Because when prices drop this much for the Nvidias, Microsofts, Apples of the world, that there's cash being freed up. That cash has to earn a return, right? And that cash, will pursue opportunity, pursue growth, pursue gains. And yeah, I mean, and it has to be someplace other than where people are. So that's in smaller stocks. That's in innovation and growth stocks. So hang in there, hang in there. Good times are coming. Good times are coming. All right. Thanks everyone for attending this live stream. I'll be back next week. Spall saying bye.